We're talking about a 0% tax rate for income and gains that total less than $98,000. Let's say you're a couple and combined you make $100,000. You're already out of the 0% tax bracket. So this becomes really a powerful tool for those in retirement where we can control how much of their income shows up as taxable. All right, welcome back to Can I Retire Now? I'm your host, Nick Russell. Today, we're going to get into one of the most powerful tax opportunities available to retirees. It's the 0% capital gains rate. You heard me, Becky. 0% taxes.
Yeah, you came in swinging big here. So
I know how much you love taxes and talking about it. What if we paid 0%?
I mean, that would be my preference. And you look really excited, but I am going to tread lightly since taxes are absolutely never this exciting.
Okay.
Ever.
Well, I know how much you, we'll call it prefer not to talk about taxes, but I thought 0%
they exist.
Could get you a little
Yes.
amped up.
Okay. 0%.
0%. So what are we talking about here? We're talking about the capital gains tax rate. So capital gains.
Yes, that is the taxes you pay when you sell an asset that you've held for longer than 2 years, a year.
Capital gains taxes in general, you're paying a tax on anything you've made money on, right? Like, so you bought something, you sold something. But we are going to specifically be focused on things you've held more than a year, 1 year.
Because that's long-term capital gains.
Correct.
Look who remembers some of my finance classes from college.
Book it. Today's date, whatever day it is. Wait, from your college classes, didn't we talk about this here?
I don't know. It's all a blur.
I get 0 credit.
No, it's probably you, actually. So, but also maybe school.
Maybe.
Okay.
So as a reminder for people listening, anything you owned less than a year. So let's say you buy a stock, you sell a stock less than a year, you're going to pay what's called an ordinary income tax rate. So basically whatever your normal income tax rate is based on the marginal rates.
Okay. So there's not like a short-term capital gain?
No, anything that's considered short-term gets taxed at your ordinary income tax rate. So anything long-term, there's only 3 tax rates.
Oh, and I bet they don't match any of the other ones for anything else.
They actually, now that I look at it, don't at all. Not even close.
Brand new numbers. Because
they're just a big swath over everything else.
Okay, so there's 3 different rates.
3 different rates.
Long-term capital gains.
So you have 0%.
Okay, that's a category.
Which we're focused on today.
Okay.
The bulk of the category of taxes are at 15%. And then there's also a 20% tax rate.
Okay.
So I'm going to give you the numbers just so that people listening have the numbers in front of them. You could Google these, but so for 2026, if you are single, you pay 0% capital gains rate on income and gains that are $49,450 or less. Let's call it 50,000 just for the purposes of today's conversation.
Roughly 50,000.
50,000. Your 15% tax rate is on everything from 50 to 545,000.
Oh, so that really is the bulk of
That's the bulk. And then if you have over 545,000 of combined income and gains, you're going to pay it at a 20% rate.
Okay.
For married couples that are filing jointly, the numbers are basically double for the 0% rate. So it's tax-free up to $98,900. So call it 100,000. 15% from that to 613,000.
Oh, a little bit higher.
A little higher, and then 20% on everything over that.
Okay.
So, what does that actually mean?
Yeah, I'm surprised the government has a category within the law that's 0%.
I don't know if you looked at the show notes, which I will brag, I prepared again. Watch out, folks. About once, twice a year, I prepare the show notes.
Okay. Yeah, I did review them roughly.
Most people don't realize they qualify or could qualify for 0% tax rate. So just like you said, you didn't even know that the IRS would allow that.
I mean, if there's a will, there's a way for them. So this is interesting. Tell me more.
So this really is something that I would say focuses more on retirees.
Oh, really?
And I would say newer retirees. So this is going to be a just into retirement kind of strategy. Okay. The reason for that is the IRS considers taxable income. Mm-hmm. when they're calculating tax rates, both your income tax rate and your capital gains tax rate.
Taxable income.
Correct. So not how much money you spend or what even gets deposited in your bank account,
Okay.
but taxable amount. So if you remember, like an IRA withdrawal is
That's an
considered taxable income.
Okay.
You know, a W-2 paycheck is considered taxable income. So if we go back to, say, the married couple, we're talking about a 0% tax rate for income and gains that total less than $98,000. So when you're working, let's say you're a couple and combined you make $100,000, you're already out of the 0% tax bracket.
Okay.
So this becomes really a powerful tool for those in retirement, where we can control how much of their income shows up as taxable, as opposed to just income for them to spend.
All right.
That
all sounds logical, and I'm just going to need some real world
I could
examples.
see it on your face.
Because
but I appreciate you absorbing
taxable income plus capital gains. Yeah, I need some real world examples here.
Okay.
Yeah.
So here's a real example. So let's take a recently retired couple.
Yeah.
We know that we want to try to keep them in that 0% rate. So we're focused on, again, let's just call it $100,000 zero. It's 98,000 and change. Let's say, for argument's sake, they had a year's worth of their income that they were going to need. They planned ahead, and they had it sitting in cash in their checking account.
Oh, okay.
So now they retire on December 31st. January 1st comes around, and they just start withdrawing from their checking account to pay their bills, live their life, travel, do all the fun stuff. If they do nothing else when they get to the end of the year, they spent, let's say, $120,000, $10,000 a month.
They have no taxable
but
income.
Zero taxable income.
Okay, so this is where you might sell something to get capital gains.
Correct.
But if you keep it under 100,000, because it's a couple, they pay 0% because it's the combined total of your income and the capital gains.
Folks, I saw the light bulb.
Okay.
I saw the light bulb go off.
I just had no idea how you would pull that off, because obviously most people need money to live.
You always need money.
Things cost money.
You need income.
Food,
you need money.
Yeah.
You don't always need taxable income. So there are things that we have talked about in the past.
That's
like
so cool.
Tax loss harvesting. You remember that one? It's one of my favorite things.
Tax loss harvesting.
This is essentially tax gain harvesting.
What?
Yeah. So when you have gains, now taking those gains, which serves a lot of purposes, by the way. If we could do it without paying taxes, awesome.
Yeah.
Obviously great.
We get the 100% of the gains.
Let's say you have a highly appreciated asset. You've owned a stock for a long time. It's made a lot of money.
Yeah.
But maybe it's a stock, so it's a little more aggressive, and you want to trim off some gains to reduce your risk. So there's an opportunity for you to rebalance your account. There's an opportunity for a lot of opportunities there.
Tax gains harvesting.
Yeah. I don't know if I created that phrasing.
No,
but I'm gonna go with it.
Okay. Yeah. Yeah. That's interesting.
Yeah.
It's interesting for me to think of people that are like, I'm gonna harvest some extra taxes here.
Yeah. So we always look at harvesting gains for clients from a investment perspective, right? We have investments. Oh my God, you're up 200%. Let's take some off the top, lock in those gains, reinvest the money elsewhere.
Wait. Walk me through how that would work. So if you've made money on a stock, and maybe you made 50 grand on a stock, you would sell the stock, stay under your
part of it,
because you'd stay under your taxable gain limit, and then just immediately reinvest in it. So you're just taking bits.
Not reinvest in the same stock.
Oh, you can't do that.
You have to wait. There's a time period you have to wait.
Oh.
But you can reinvest the money in something else. Presumably we're taking profits because it's grown so much. Maybe that's too much of our portfolio.
Oh.
So we're looking to lock in those gains, but then reinvest those assets somewhere else.
Okay.
But now imagine our example you asked for, that recently retired couple with the cash in their bank account. Yeah. Now we could take almost $100,000 worth of gains.
Yeah.
And by the way, I'm not an accountant and I don't play one on TV, but your taxable income also includes things like your standard deduction. Or now, because of the One Big Beautiful Bill, there is an extra senior tax credit of $6,000. So all of a sudden that 98,000, you could really have about $140,000 maybe of gains and still have enough deductions to get you down under that $98,000 number. So just throwing that out there.
Oh.
But let's say we were that couple.
Yeah.
And we lived on the money in our checking account because we prepared over the course of the year.
You knew you were going to sell something.
We knew we were going to do it. Now we can sell $100,000 worth of gains, pay zero taxes. And guess what? There's our $100,000 of income for next year that we can now, or it's in our checking account.
Riding the wave for a couple years.
Bingo. Yeah.
Okay. So when we started this, you said this was really something for close to retirees, new retirees.
New retirees.
And why is that?
So the core idea of what constitutes into this number is taxable income. So if you are still working, like we are working.
Oh yeah, you can't limit that.
If we're making over $98,000,
you get paid.
Plus gains that you're trying to take, it's hard to stay under that number. You
can't tell your employer, like, just keep it for later. That doesn't work. Sorry.
Yeah, I don't know if that, I don't know if first many people that would ask that.
No, okay. So if you're recently retired though, why wouldn't you you can choose not to take withdrawals from your investment accounts and also not have Social Security yet?
Potentially.
So
let's say full retirement age now for Social Security is age 67.
Okay.
So let's say someone retires at 65.
Yeah.
They qualify for Medicare, but they're going to wait till 67 to draw their Social Security, because you're absolutely right, by the way. Social Security is a taxable income. So if all of a sudden you're drawing Social Security and that combined, couple maybe is pulling in $60,000 a year in combined Social Security, well, now there's $60,000 right off the bat.
Yeah.
We can only get to 98.
Okay. So you're possible, but not
possible, but maybe a smaller amount.
Okay.
And by the way, I think the smaller amount is worth it. So if there's room for that, there's plenty of clients that we have that even though they live a six-figure lifestyle in retirement, we're not paying income taxes on six figures of income, because we're taking income from non-retirement accounts, Roth IRAs, other, not tax sources.
Okay. And also planning when you're making those withdrawals and all this stuff. Yeah. Because you have something to sell. So you can, if you see that on your horizon, you can plan accordingly and somehow pay 0%.
0% capital gains tax. And this actually reminds me of a previous conversation we had in one of the other episodes about, you had asked me a question about retirees and cash on hand. And very similar to this, the couple of years prior to someone retiring, we start to morph what their investments look like. Instead of being one big bucket of moderate risk tolerance, asset allocation stuff, we start to pull out cash. And when I say cash,
I never would have thought of that.
Yeah, it could be money market funds, it could be CDs, it could be treasury bills. Be careful, the interest earned is taxable income. It piles into that number.
They always find a way.
Yeah. So you have to, this is why you have to work with an advisor. It's why earlier this year, I invested in this tax software that we now have at the firm. And accountants are great because they can look at all this tax information and help. But you kind of have to do this forward looking.
Yeah, you do.
You can't just say, oh, well, what happened last year? You really need to be able to think in advance. And in this case, maybe a couple of years in advance to say, I'm going to start freeing up cash now out of my portfolio and hoard it. And then when I retire, I'm going to live off of that, or part of my income is going to be from that, so that
I can sell my house. I can sell my
I can start to take gains and not pay taxes on it.
I'm going to say something and you're going to I don't know how you're going to respond to this, but this is such like a simple concept that you obviously have understood your entire career. And it's taken me till I was in my mid 40s to figure out. But retirement is equally about, I've always thought it was just about saving, but it's almost equally about tax planning.
It is very much
like
about
that's
tax planning.
Insane to me, because no one ever talks about taxes in retirement, but they're like involved in literally every single step.
So I have said this to people, how look, I never wanted to be an accountant.
Okay.
And I'm not.
Okay.
And I remember even as a little kid, my mom realized I was good at math. She goes, her saying was, she goes, I've never met a broke accountant. Like,
well,
that'd be
it's a good career.
Right. And I'm very lucky to be doing what I'm doing now.
Yeah.
And I love it. But you're absolutely right. Every investment you ever, basically almost every financial transaction you make,
that's what I'm saying,
has a tax. You buy something, there's sales tax.
You save something,
You pay.
they tax it on the way in or the way out, or
Bingo.
both. I don't even know.
They tax it out of your paycheck, payroll taxes. You earn interest in that CD you invested in. You pay taxes on your interest. You pay property taxes on your house. You pay capital gains.
I don't know how people do this on their own.
Yeah. And
because there's so many, you would miss out on your 0% capital gains if you didn't know any better. So,
and I would tell you, if you think about the type of person from an asset level or an income level, like who this would really be good for. Well, it's a no-brainer for, somebody on say the lower end scale, because maybe they're living on less income in retirement. That all of a sudden they're way in those numbers, and they could make some movement with their money and not pay taxes on it. Well, all of a sudden now they have more room to breathe and get more out of their money.
Sure.
And I would argue everybody all the way to the other end. You have somebody who's a high net worth individual.
Okay.
Tax planning arguably is more important than the investment planning.
It really does work for everybody.
It really does. Now, I would tell you, if you have who it doesn't work for. How about this?
All right. First, my people.
I'm thinking of clients of mine. Like, I have clients who both have a pension, both are taking Social Security income.
Oh, so they have income coming
regardless.
They can't stop it.
Correct. Say someone, I said early in retirement, say someone who's like 80 or 85 and has most of their assets in an IRA. Well, the RMDs alone, the required amount they have to take out.
Required minimum distribution.
Those are taxable. So those show up as taxable income.
Yeah, so you really need to do this before all those things start coming and they don't stop coming.
And they don't stop coming and don't stop coming? What's that song?
I think it's Hey Now, You're a Rock Star.
There you go.
Yeah, whatever that song is.
Wow.
Okay.
Smash Mouth.
Becky reference Wagoner. In the capital gains podcast. Okay.
And it's a real thing. And you mentioned, hey, I'm in my 40s and I'm just understanding this now.
Yeah.
This is a concept that I would argue most people. Yeah. And this isn't one of those like, oh, well, I'm a financial.
It's a pretty dry topic. It's not coming up over drinks.
No, it's definitely not something you talk about on Friday night.
Have you heard about the 0% capital gains tax bracket? No one.
But if people did talk about it, I mean, come on.
They'd have less social engagements.
Why don't I have any friends? But it comes up in odd cases too. Let's say someone takes a year off of work to go back to school. Now they have zero income. They have some investments. This would be an opportunity. We talk about things like Roth conversions, which I know is a whole different topic. Yeah. But there's another example of something you can do, but it creates taxable income.
Yeah.
But if you're in a no income or low income period for some reason, it's another thing like that you could force yourself to have income that's taxable, but keep it at a rate that is literally zero or very low.
Dare I say, this is a useful tool all around.
I never thought I'd hear you say something so sweet about taxes.
No, me either. Color me surprised.
I don't know. I don't know why. Was it Titanic? Like, paint me like one of your French girls?
What?
Is that from Titanic or something? I was going to color you like one of my French girls.
Gosh. Things are going off the
I'm getting sidetracked.
Okay.
So 0% taxability. So we talked about cases, I think, no brainer if people are listening. That people are listening. Otherwise, they wouldn't hear me say this. New retirees are like an absolute sweet spot. First couple of years of retirement, you do have to plan for this a year or two in advance to make sure you know where your income's coming from so that you can keep your taxable income to low or zero.
Yeah.
It starts to not be as possible or attractive when people start drawing Social Security because that's taxable income. And especially once they're old enough for RMDs, because that's taxable. But if people have been smart enough and saved in other vehicles other than their 401k, maybe they have Roth IRA assets, maybe they have non-qualified or non-retirement assets. Those are places you could go to touch.
Is this like does real estate fall into that category somehow? Or
So-
is that different?
So real estate can. You want to throw real estate into this? So
Just briefly, just touch on it.
real estate, like an investment property, can be your capital gain we're talking
Well, that's
about.
what I think. No, people downsize, right? Like when they retire. That's different.
So here in the state of Florida, we're married. If we sell our primary residence, we get the first 500,000 of gains tax-free anyway.
Oh, so there's whole different. Okay.
So not every state has that.
Okay.
We have that for sure. Most states have some iteration of that.
Okay.
But let's say we sold our house and we made 600,000.
Yeah.
Well, the first 500,000 is tax-free.
Yeah.
Now we have $100,000 of gains. We still have our standard deduction. We still have, all that kind of stuff. But maybe if we don't show income
that year, we're going to sell.
Let me give you it's a tough example to imagine now because homes cost so much. But let's say we sold our house for $1 million and we bought a house for 500. And in that example, we had $100,000 gain. Well, where'd the other $500,000 go? Probably in our bank account.
Yeah.
So all of a sudden we can pay a 0% tax rate and sit with
$500,000,
$500,000 or 400,000, whatever it is in our checking account. Yeah.
Nice.
Yeah. So
let's hope we make $600,000 on our house at some point.
Okay, weirdo. So you brought up what I think are some hidden traps where people hear the words, the word 0%.
Yeah.
And you nailed the first one, which is retirement, real estate sales.
Okay.
Real estate sales or rental income on existing ones, that's taxable income. Anything after deductions. People think, oh, I won't take money out of my IRA, but don't realize that there are other income sources they're receiving. Roth conversions. People, it's very powerful tool to do, again, in those same kind of years.
Yeah.
But if you do an IRA to a Roth conversion, now all of a sudden that amount is taxable income.
Oh, yeah.
So you probably can't do both in the same year.
Up on things.
Yeah, because all of a sudden your taxable income might be 200,000.
Shooting up into the high bracket.
Also, any kind of large, just general IRA withdrawal. There are people still this day, God bless them. They need to talk to someone who the day they retire, they take money right out of their IRA or 401k to pay off their mortgage. Let's pay 25, 28, 30% taxes on that money to save our 3%, 4% on our mortgage.
That math doesn't always work.
No, that math doesn't math at all. Yeah. And maybe it did when interest rates on homes were 8 to 10%. Yeah. But, a lot of people have these 3.5%, 4.5% rate. It really doesn't work for most people. We mentioned Social Security. Only thing I think worth considering is if you do have a larger pool of non-retirement assets, say you sold a business or inherited money, any interest, like I mentioned CDs, but interest or dividends earned on those assets are also factored in taxable income. So there are a few little bits and pieces, which is why, like for me, mid-year, third quarter, I will take whatever clients have earned over that period, annualize it. And now we have an idea of what. So maybe the year before we planned where we're drawing our income. So we have cash on hand. But throughout the year, we earn interest and dividends. So it's not going to be like we have zero income. We're going to have something. And then we just do the math backwards to figure out what we can take.
Planning, Nick.
Well, it's in the title, financial planner. So I mentioned, I put here some case studies, but we kind of talked about them. Early retirees, let's say 62 to 65, usually have lower taxable income. Great time for this tax gain harvesting, as we're calling it, or I'm at least calling it. That next phase, kind of that 67 to 73, is usually drawing Social Security at that point, but still needing to take money out of their IRAs. So that helps. Once you get past 73 and you're taking IRA distributions and you have Social Security, it's a little tough. But I did mention high net worth individuals as well. This feels like a lower income strategy because we're talking about,
but also not, because if you can put money in the bank like in large chunks, then you obviously are doing well.
And usually your higher net worth people have more non-IRA investment money.
Okay.
So what you can do ahead of the year you want to do this is move the money around so that you have less taxable, interest and dividends, and then you can take those gains. So for people listening, if you're getting close to retirement or you just retired, I think it's a very opportune time to have your advisor look at your portfolio, give you an analysis on what's expected from interest and dividends, look at any highly appreciated investments you have. Hey, the stock market's been really great the last handful of years. So there's probably a lot of holdings in there, hopefully, that have made you a lot of money.
Yeah.
And before you get to the end of the year, because this is a tax year
You got
thing,
to plan ahead a little bit. Yeah.
figure out what you might be able to do. And again, with senior exemptions and standard deductions and all that kind of stuff, there's more room now to take this at 0% than ever before.
Great.
I think it's a great strategy. It's something we've done with clients over time. And it's, and by the way, something we didn't talk about, but as just for FYI, for people that are nervous about doing this wrong, let's say you take too much gains and you go $1 over that number.
Oh, rats.
See, yeah, you're thinking like, because you've learned.
No, find another deduction. I don't know. What do you do?
Oh, no, just that extra $1 gets taxed at the 15%.
Oh, well,
so
that's
it's so it's not like it messes up the whole thing and all of a sudden, oh my God, now everything's at 15%.
Oh, that's
and I was
good
expecting
news.
0. It's a marginal rate. So it's only the numbers that nudged over. So if it doesn't work out perfect,
you can have that 15 cents.
And you botch it. Yeah, they could take the 15 cents.
Nice, Nick.
All right. I know that was a little heavy, but 0% is the right kind of percent. So what are your thoughts?
I have a brief fun fact for you about capital gains.
You found a fun fact about capital gains.
Well, it's not really fun. These are just more facts. But so we
might have to rename this segment "Just Facts" with Becky.
So capital gains in the United States started in 1913 with the 16th Amendment, which people can go read. So anyway, I looked at the various levels of income tax over the years.
It's wild.
Yeah. And I did the classic mean, median, mode type situation. And highs and lows. What do you think the highest capital gains tax bracket was ever since 1913?
Since 1913. I know that the highest income tax rate was like 90% at one time, which is nuts to think about.
Yeah.
So it's got to be less than that, but still probably pretty high. 60%?
Higher than that.
Ooh.
Okay.
75.
Yeah, around there. It was 77%.
Ooh, okay.
In 1918.
All right.
They were taxed at that rate because they were not treated as a separate lower tier income. They were taxed at an ordinary income rate, and they did that to support the cost of World War I.
Oh.
Yeah.
Okay.
But the lowest was 7%. That's what they started out with in 1913.
Wow. So the 7% I'm assuming is like what our 15% is now. And just so you know, in case you probably found this in your research, there has been a lot of talk over the last couple presidencies about raising that 15 to 20.
Well, yeah. So
where it's come down, but it's talking about coming back up.
So just the average in the entire history of capital gains is 24.7%. So about 25%. The most occurring was 20. The mode of them is 25%. So we are right in there, right average, and a little bit below according to history. So all is good in the hood. At least we're not at 77%.
No, I would say that in theory, a higher capital gains tax rate would incentivize people to hold their investments longer.
Yeah. I mean, there's a whole bunch of different things.
Right.
Yeah.
So I don't like paying more taxes than I need to.
Yeah.
But I understand the idea of higher capital gains taxes. But that's.
So that is your plain old fact.
Plain old fact with Becky. Well, for more facts like that, you can find her at caniretire whatever.
Yeah, riveting content.
Yeah. Well, hey, our income tax rates are at historic lows right now. Capital gains taxes are lower than average. This is a prosperous time from people that obviously you don't like to pay taxes or you don't like to talk about them. I don't know. It is a good time for strategies like this. It is probably one of the more attractive times, at least in my 21 years as an advisor, to look at strategies like this. So, yeah. So thank you for letting me educate and chat with you about it.
And where can people reach you if they want to know more?
Best place to reach us is the website, sunrisewealthadvisors.com. We're on all the meads, all the social medias. So you can find us on YouTube, LinkedIn, Facebook, Instagram, X. We don't have a Pinterest channel yet. I don't know. We're maybe you could start that. But follow, subscribe if you like the content. We appreciate all the listeners and followship, and please let us know if there's anything you would like to hear more of. We are taking client requests. I've been making a short list of everybody's like, oh, we'd love to hear you talk about all this stuff. And 0% taxes was a big ask. So thank you for listening. Find us online and listen to us next time.
Have a great day.